In this course, we discuss key financial documents involved in double entry bookkeeping.
We'll show you how to read a balance sheet, a profit and loss statement, and a cash flow statement. We focus on these three documents in particular because they help complete the financial statement package. Together, they provide vital information concerning an organization's operations and finances.
In this first lesson, we'll review some key terms and foundational concepts that are important for double entry bookkeeping.
First, double entry bookkeeping records each financial transaction in two different accounts, one as a debit and one as a credit.
Second, the accounting equation is central to working with the balance sheet. It states assets equals liabilities plus equity. An asset is something that an organization owns. Assets include cash and bank accounts, investments, accounts receivable, inventory, office supplies, buildings and equipment, patents, goodwill.
Some of those are fixed assets, which are tangible. Examples of this type are buildings and equipment.
Some assets are intangible, such as a patent. A patent's value is not in its physical presence, but in the legal protection it provides.
Other intangible assets are goodwill, covenants not to compete, brand name, and even the purchase of client accounts from other businesses.
Let's take a moment to consider inventory specifically, because there are two types of inventory. There's merchandise inventory and work-in-process inventory. Both are assets. Both types of inventory add value to an organization.
Differentiating them on the balance sheet enables a company to see what's ready for sale now and what will be ready for sale in the future.
Let's review liability accounts briefly. Liability for accounting is exactly as it sounds. A liability is something that the organization owes to somebody else, like accounts payable. Your vendor sent you a bill, you owe that money to the vendor. Therefore, it's a liability.
Another is expenses payable such as rent, salaries, and taxes. Those are all liabilities because
you're holding them to pay to somebody else.
Liabilities are divided into short-term and long-term. Short-term or current liability is something that is going to be paid in less than a year, within 12 months, such as accounts payable or a short-term loan.
And a long-term liability is something that's going to be paid over a longer period of time, beyond 12 months.
The last part of the accounting equation is equity, specifically shareholders' or owners' equity. To calculate equity, we first add the value of all of our assets and liabilities.
The difference between assets and liabilities is our equity, or net worth. When our liabilities exceed our assets, we have a negative equity or a negative net worth. And when our assets exceed our liabilities, we have a positive equity or a positive net worth.
Remember, the double entry accounting system says for every debit, there should be an equal and opposite credit. But keep in mind, that doesn't necessarily mean one debit to one credit.
For example, you may have one debit to 3 credits, or 2 debits to 5 credits.
Or 5 debits to 2 credits.
Exactly. It doesn't matter how many in quantity are being posted to each account, but the total dollar amount should always equal.
And now, a reminder about applying all those debits and credits. Debits and credits affect some accounts in one way and other types of accounts in an opposite way.
How accounts respond is determined by whether they have a normal credit balance or a normal debit balance. Whatever is normal is what will increase the account balance.
For accounts with a normal debit balance, a debit will increase it and a credit will decrease the balance.
And for accounts with a normal credit balance, the reverse is true. A credit increases the balance and a debit decreases it.
So whether you're looking at assets and liabilities on the balance sheet,
or expenses and revenues on the profit and loss statement,
the normal balance of an account determines the effect of the credits and debits.
Next, we'll examine the general ledger, which is where all of an organization's financial transactions are recorded. Every transaction recorded in your accounting system needs to be posted to the general ledger, which uses specific account numbers to categorize the types of transactions.
By organizing these numerically, specific accounts can be located quickly and efficiently when needed. The chart of accounts, also called the General Ledger Account List, provides a listing of the accounts used for recording financial transactions in the General Ledger. Here, you see the T accounts, debits on the left and credits on the right. With the account number and name at the top, it all fits to a T.
Yes, and there's a column for the balance to the right of the T and a column for the date to the left of it.
After the amount of the transaction is placed in the proper debit or credit column, the balance is adjusted accordingly. Let's look at a couple of examples.
We'll start with accounts 125 and 610, supplies inventory and supplies expense. Consider the following basic scenario. Items worth $820 are taken off the shelf out of inventory. We then record that action by decreasing account 125, supplies inventory, and increasing account 610, supplies expense. Remember, there are always two steps in double entry accounting.
To decrease supplies inventory, the account is credited $820. At the same time, the supplies expense account is debited $820.
So for every transaction, there are two sides to that transaction. Something is debited and something is credited. One account may be increased and another account decreased.
Or both account balances could also be increased, or both accounts could be decreased. What remains constant is that there always must be a debit and a credit.
Let's look at one more example from the chart. Let's say we wrote a check for a bill, decreasing our bank account by $1,180. In that case, we credit account 101, cash on hand, to reduce it. We also decrease accounts payable by a debit of $1,180.
One final point about numbering is that organizations don't all use the same system. We've used an illustration with 3-digit account numbers.
Some companies use 4-digit account numbers.
Some may even use 5.
Since different companies use different systems, it's important that you understand the one used by your organization.